The most common critique of Bitcoin sounds devastating. It produces nothing, it has no CEO, it generates no revenue, and therefore it has zero intrinsic value. This argument relies on a very specific type of financial logic. It evaluates Bitcoin the same way you would evaluate a publicly traded company, by projecting future cash flows to calculate a fair price. That framework exists because a share of stock is a legal claim on the profits of a working, productive business. But applying that metric here is a category error. Asking for Bitcoin's quarterly earnings makes as much sense as asking for the profit margin of a €100 note. These things belong to a different class, called monetary assets. Their entire function is to store and move value across time, not to generate a corporate profit. To judge Bitcoin accurately, we have to put away the stock market spreadsheet. The only honest yardstick is humanity's oldest and most successful monetary asset, gold. For 5,000 years, gold has been the global standard for real, solid value. Most people assume that worth comes from the fact that it is a physically useful metal. However, data shows only about 5% of gold demanded each year is used for practical purposes, like electronics or dentistry. The other 95% of gold's multi-trillion-dollar valuation sits idle. It is cast into bars, locked in central bank vaults, or worn as jewelry. If industrial utility were the only measure of value, then $30 trillion of the gold market would be an exercise in shared imagination. Historically, monetary value hasn't come from a factory. It comes from a specific checklist of properties that allow an object to function effectively as money. This scorecard shows the 6 essential pillars of good money: scarcity, durability, portability, divisibility, fungibility, and verifiability. Evaluating modern fiat currencies, scarcity is their weakest point. Their supply is controlled by human committees, who expand it at will, steadily eroding savings. Gold performs much better on scarcity and durability, but it fails on portability and divisibility. It's heavy to move and difficult to split into the tiny pieces needed for daily purchases. Bitcoin matches gold's strengths while solving its physical limitations. It's instantly portable and infinitely divisible. But its primary feature is here. Bitcoin's supply is mathematically capped at exactly 21 million units forever. This leads to the most important question for any skeptic. Because it is software, who actually guarantees that limit? What stops a company or government from just changing the code to make more? The guarantee comes from decentralized consensus. The ledger is maintained by thousands of independent computers globally. If one node attempts to change the limit, that version of the record is instantly rejected by the rest of the network. To raise that limit, you would have to convince millions of independent users to voluntarily dilute the value of their own savings. It is a change that defies the self-interest of everyone involved. Because no one is in charge and the rules cannot be altered by a committee, Bitcoin possesses a level of scarcity that cannot be forged or inflated. Value in a monetary asset emerges when rigid physical properties intersect with a growing network of shared belief. If Bitcoin is such a strong store of value, we have to address why its price swings so violently compared to gold. We have a rigid, flat line representing a perfectly fixed supply colliding with uneven waves of global demand. When new buyers flood in and the supply physically cannot expand, the price of each unit must rise to accommodate them. Those aggressive surges and drops are the natural side effect of a young asset discovering its market value in real time. For many, the final barrier is the fact that you cannot physically touch it. There is a deep discomfort in owning something that lacks a physical form. But gold's physical weight was its greatest historical weakness. It's why we were forced to adopt paper money in the first place. Bitcoin's value exists because it is digital. It preserves the properties that gave gold its worth for 5 millennia while discarding the physical constraints.